Today on the final bar, we're going to wrap the week from the Las Vegas Traders Expo, talk about the market resilience, hanging up on new highs. Had a lot of conversations with experts here in Las Vegas talking about market outlook. Overall, pretty constructive. So we're going to look at the moves this week, how it fits into the big picture, and also have some really good examples of interviews from this week. So from Las Vegas, ladies and gentlemen, this is the final bar. Ladies and gentlemen, thanks for joining me today here on the final bar. This is your host, Dave Keller. I'm the Chief Market Strategist at StockCharts.com. Instead of coming at you from our headquarters in Redmond, Washington, we're broadcasting live from the Traders Expo in Las Vegas. Had a great two-day experience. This is day two of our experience down here. Sat down with a number of really capable analysts, strategists yesterday, guys like JC Peretz, Dan Gramza, and we're going to share some snippets of their interviews later in the show today, but a lot of really good content that we'll hope to share with you in the coming weeks and months. A lot of good discussions about the market, and you know, it's a fascinating time to be talking with people about the market environment with the equities in the U.S. and also abroad. You know, just showing resilience, showing strength. So I had a lot of conversations about stocks versus commodities versus bonds. And as we wrap the week here in a moment, we're going to share some of the takeaways that I had from them. But I think you really appreciate some of the comments from JC and Dan a little later about what they're seeing as well. So let's wrap the week here. On Friday, what we like to do is take a step back. You know, every day we like to look at the short-term movements of the day connected to the long-term, but especially on a Friday after the close, it's really a good time to think big picture about what this new week has added or subtracted from the overall trend. Where are we at? Sort of take a step back, 30,000-foot view, understanding the environment. So let's get to it. So, you know, in general, you know, the market's continuing to show signs of strength. You know, a lot of the conversations I've had with attendees here and at the Traders Expo is about leadership rotation, right? The concerns about breadth, the concerns about small caps lagging in a bull phase, the concerns about leadership in terms of defensive sectors like real estate and utilities being so strong at a time when you might not expect that. But if you think about it, just in this week, I think we've finally gotten some clarity as some of those things have started to resolve. You know, here's a chart of the a daily chart of the S&P, and then we'll get into some of those other themes as well and how they've evolved over the last 5 days. So, you know, this is what this week has done. It's sort of a gap week. We jumped up. Friday was a really strong session, opened up a little higher. Choppy around. We really haven't gotten much further directionally by the end of this week. And full disclosure, we're recording this a little earlier on Friday midday to make room for some interviews we're going to be doing this afternoon. But you know, so depending on how the market closes out on Friday, the picture could change just a touch. But overall, I think the trends are going to be pretty consistent. So certainly a follow through week to the upside. And again, the high level chart of the S&P is one step. Looking under the hood at some of the other, you know, confirmatory evidence, thinking about, you know, some of the different ratios we've talked about, breadth, picture, and so forth, I think will help describe why this week I think was so important to the bull case, to be honest with you. You know, it's one noteworthy point ending the week here near or at an RSI overbought condition. And again, a lot of people, I think when they're just getting started, they think of that as a bad thing. And a lot of systems actually color code the overbought line as red, as in when you hit this line, you know, you got to watch out. I'm thankful that at StockCharts we have a sort of a neutral color because it's not a bad or good thing necessarily, right? I think, you know, all it does is it describes price behavior. The fact that the RSI is around 70 means that the trend has been positive, and we know that just from looking at the chart. If you look back to June and July, I think it could be an interesting parallel to what we're seeing now. If you look, we just touched the overbought region here, you know, the second or third week. You can see in June, we had a little bit of a pullback for a couple of days, but then the uptrend continued. We then became overbought a number of times over the next couple of weeks. And the real signal, the real interesting pattern was the divergence when we went high at the end of July and we had a divergence of lower peaks in the RSI. That bearish divergence is what suggested we might have a little more of a corrective move. And that's what happened, obviously, the first couple days in August. So my point is, we're not at that sort of environment where it's telling you we're overbought. Uh-oh, we really need to be worried. It's more of sort of the early on in the acceleration phase, market going to new highs, momentum following through, stocks breaking out, a lot of new highs on the equity list. That's what happens sort of at the beginning when the trend emerges. Later is when you have an exhaustion of momentum, and we're not there yet. So overall, trend's still in pretty good shape. Again, it's really important, I think, to always orient ourselves to the long term. And by any measure, you have to remember that stocks are in a really good uptrend. One of the analysts I used to follow before he passed away, unfortunately, a number of years ago, Paul Montgomery, wrote a piece that we got, an institutional research piece that many of us got for years. And he always said the most bullish thing the market can do is go up. And we forget that is all that needs to happen, right? The trends are explicit. The trends are right on the page. This market over the last 6 years has gone up and to the right, with notable exceptions in 2015, the sell-off at the end of last year. But overall, we are in a much higher place than we were by any look back period over the last 6 or 7 or 8 years. So it's worth remembering that even with all the macro concerns, all the potential headwinds, the trend is positive and certainly seems to remain so. I want to dig a little more into some of the equity themes, but I do want to take a moment because a lot of my guests that we've been talking with here at the Traders Expo, more intermarket oriented, a number of people, Todd Gordon from Trading Analysis, JC Peretz. We talked a lot about John Murphy's work, his book Intermarket Analysis as being a seminal work in their growth as investors. And what we saw was in those conversations was just thinking a lot about interest rates, a lot about gold and oil and how they relate to what we're seeing in equities. So equities look good, equities are strong, great. But what else, right? What are all these other levels that people can pull? And I think the good thing is there are a lot of opportunities through ETFs to access a lot of different markets. The challenge when stocks are doing so well is we get very much, we put the blinders on as investors. It's like stocks are working great. I don't have to worry about anything else. I would encourage you to make sure your process includes a lot of these other markets though, because then you will really understand when it's the time to rotate away from equities. So one of the main things we talked about was just the interest rate environment. My conversation with Dan Gramzo will touch on this a little bit later in the show, but I think it's worth noting that the TLT, this is the way we usually look at bond prices. There are a number of ways you can do this, number of ETFs, number of indexes that track it, but the TLT is pretty liquid, and I think it's pretty widely followed. So here we have this coil pattern, this congestion pattern, a sideways consolidation pattern of sorts. It's worth noting that we never really established that second, that bottoming pattern. So after I drew the line, we immediately broke down, sort of retested it, and now have followed through to the downside, now breaking below through the end of this week, below the low from September, which felt like sort of a floor in the market. It felt like it was going to take forever to test that because there was such a significant bounce off that level. But now this whole pattern feels a lot more distributed than it did a little bit ago. This felt more like a pennant pattern or a flag pattern, right? Maybe more like a pennant where, you have a big run and then you have sort of this consolidation. A lot of times that resolves higher. That's sort of a halfway point. But now it feels more like a lower high and now a lower low. We now have a subsequent lower high that's sort of confirmed the downtrend. So overall, this real rotation away from bonds into stocks, and bonds had been a market that had been so strong for so long. We also talked with a number of the speakers here about gold, and it felt so positive here not too long ago. 2 weeks has made a very big difference, I think, on the chart of gold. And the GLD, for example, now testing the support level from the end of September, beginning of October, and that breakdown is what's really potentially key. We haven't quite done it yet. I think it remains to be seen if this is a support level that holds or not. But if I don't have, this is not one of the 3 and 3 today, but if I had 4 and 4, this would probably be the 4th chart. So keep this one in your pocket. And the fact that we now have an underperformance from the GLD from gold, I think is really interesting. I want to talk a little bit about sectors here to wrap up this weekly discussion. Today we've got healthcare leading the market, really flat here at in the early afternoon Eastern time. Healthcare, materials at the top. At the bottom we have utilities and energy, consumer, discretionary and staples. Again, similar yesterday, kind of moving in lockstep. You really, I like to look for signal when there's a differentiation where discretionary up at the top, staples up at the bottom, or the opposite. And that really indicates offense versus defense within consumer. We really haven't seen that. both the consumer sectors have been relatively weaker, and that's why that ratio has not really changed a whole lot because of that phenomenon. I wanted to look at the industries here to finish up, and what I'm gonna do is look at the 1 week change. This is on the Scooter Reports page. So if you're not familiar with this, click on Charts and Tools in the upper left, go to the Scooter Reports, and you can select what group you're looking at. I'm just looking at industries because I wanted to focus on what industries are really getting it done, which ones are not, and then look at the changes. So at the top of the ratings, if I just sort the whole thing based on the Scooter ratings, you can see the groups at the top are computer hardware, furnishings, fixed line telecom. So that's things like AT&T and Verizon, kind of the really boring part of the old telecom sector. Those are really the strongest right now based on all the industries. So we got about 100 different industries in the Dow Jones universe. Those are the ones at the top. At the bottom, it's things like coal that's really been unloved. So I'm not that surprised by that. It's not really done a whole lot. And this, you can see the quick preview of the chart. I mean, down and to the right, one of my mentors always used to say, never confuse the bottom of the page with support. So when something like coal is going down and to the right, don't assume just because it's really low that it will stop going down. You can always recalibrate the chart going lower. But some energy things down here, some REITs, which really mirrors what we've seen. But also things like restaurants and bars. This is a group that had been really, really good. Look at that rotation. I want to look at this chart really quickly. Talk about a classic rotation from accumulation to distribution. And that's things like McDonald's, Starbucks, I want to say is in here. I can't remember what all is in this group, but overall a real rotation from strength to weakness, which is something to remember. One last thing, I just want to look at what industries have changed the most in the last 1 week. So I'm going to sort by the changing tab. So what was down the most just this week? Mining stocks. So we looked at the chart of gold. That's obviously affecting there. A lot of REITs that have gone on the bottom, and travel and tourism has been one of the weaker moves over the last 1 week period. At the top, non-ferrous metals, delivery services, tire. So the reason why I love this report, and I'd encourage you to dig a little deeper, some of these groups I guarantee are names that you are not used to looking at. And the fact that these are the ones that have appreciated the most over the last week means they deserve your attention. So we don't have time to dig any further into it this time. I'd encourage you to take some time on your own, dig into that. And all you do is look at what you're seeing there, then look at the industry summary page. That's where you can break down the constituents, look at the individual stocks and see what movements you see on the upside and downside. So that's our Wrap the Week segment for today, for Friday, November 8th. I want to introduce my first interview today. We have two of them for you. The first one's with Dan Gramza. Dan's the president of Gramza Capital Management. He's a fellow Midwesterner, is based out of the Chicago area in Evanston, Illinois. You can find more about him on dangramza.com. Dan's a longtime trader, educator, has done a lot of work with the CME in Chicago, and sat down together to talk about the markets. What strikes me about him, very thoughtful investor, thinking about large cap equities versus small cap equities, also the interest rate environment, which was really helpful. Really key point about the importance of large caps and how much international exposure you get. So here's my conversation with Dan Gramza. So Dan, thanks so much for joining us today. We've got the U.S. markets, equity markets, continuing on to new highs. A lot of potential leadership rotation with defensive sectors like utilities and real estate starting to roll over. What are you seeing right now in the equity markets, U.S. equity markets, going into year end and into the beginning of next year? Well, when I think about the S&P or the NASDAQ or the Dow, I'm bullish on those indices. I do look for strength coming into the end of the year. I think we have enough economic foundation in place that it supports that marketplace, and I think it's going to continue. Are we going to have some changes here and there in the marketplace? Sure. We're going to have a tweet that creates volatility? Yes. But what we want to remember about those kind of things is that there are the anticipation of something typically. Right. They're not the reality of it. So does the market react to it? Yes. Is it sustainable? Probably not. So I don't look for trend changes on concerns. Right. Now, one of the challenges a lot of people have thought about with the market, besides the sort of defensive leadership up until now, has been small caps and a lack of participation from smaller, mid-sized companies. What are you seeing with something like the Russell 2000 versus a bullish outlook for broad market? Well, that's a good one. Yeah. That's a good one, David. And I do look for positive movement in that marketplace. Okay. But what we want to remember is the S&P 500, 50% or 45% of their income comes offshore. Yeah, right, so we want to pay attention to that international news that could have an impact
on those companies. The small to mid-cap companies really don't have that exposure. But we also want to remember, when our economy heats up, the small to mid-cap has a tendency to lead because they're a little more nimble than those large cap stocks.
Right. It's such a great point. I think so many people think of buying the spiders as buying U.S., but you're really buying a lot of global exposure when you buy large U.S. companies, right?
Exactly.
A lot of people don't appreciate that probably.
That's right.
Yeah.
That's right.
Now, obviously, we've had an interest rate environment that's been frustrating, challenging for people. Bonds have been on a tear, but then now starting to break down. Something like the TLT, breaking to new swing lows. How does that bullish equity call line up with what you're seeing on the interest rate side?
Well, I have to tell you, I like the way interest rates are behaving.
Okay.
And when we talk about futures, now we're looking at interest rate prices for the 10-year notes or the 30-year bonds. Prices, I'm looking for them to go lower.
Okay.
And the reason is that we're seeing capital switch between interest rates and stocks.
Yeah.
So when stock market gets stronger, I'm looking for weaker prices when it comes to the interest rate markets. So I think they're right on target. I also like the Fed policy right now.
Okay.
That I think goes hand in hand with that. I like that they're taking a pause. I like that they're not doing another decrease, actually. When you have 3 decreases in a row, typically in the past for the Fed, the stock market has a tendency to be strong.
Right.
If you have 4 in a row, it has a tendency to be weaker.
Oh, interesting.
And I think it's the perception that the economy may not be doing well,
right.
And that's why they did the 4th.
Isn't
so
that
I
great?
like what they're doing. And when the Fed changes their interest rates, it takes 6 to 9 months before our economy feels it. So
right.
I don't want to see high frequency in terms of them changing the interest rates too often.
Yeah.
I like that they're taking a pause, and I like the approach that they're taking right now. It's a tough job, but I think the attitude they have for the market, it's going to be good long term.
It's a great thought, and we had Tony Dwyer from Canaccord on the show recently, and talking about the same thing, the third rate change and what that means for stocks. Exactly what you said. It tends to be a pretty bullish sign as long as this is where it stays. So that lines up very well with his thoughts. If we could, can we go back to your thought about the S&P 500 feeling pretty strong? What I love to ask is, there something that you would see that would tell you that's wrong? Like, is there a specific level or a specific breakdown, a certain signal of some sort that might tell you, it's no longer bullish, things are starting to change? What would you be looking for to maybe reverse more of a bullish thesis here?
Ooh, I like that question.
Good.
I look at fundamentals and technicals.
Sure.
Fundamentals create the belief that someone has about the market. Technicals are the thing that really determines my final decision.
Right.
Because price puts money in my pocket and price takes money out of my pocket. My opinion is just that.
Yeah.
It's how price behaves that's critical for me. So I'd be looking at bearish indicators. Now, a tool that I use, it's not the standard approach, it's a different approach, but are Japanese candle charts.
Okay.
And what I would be looking for on a weekly chart is what I call rejection patterns. It's where you start seeing larger shadows on the top. And that could be an indication of a rollover
Showing a little bit of distribution there during the week.
That's right.
Great thoughts. Dan, thanks so much for joining us today. It was really great.
My pleasure.
All right, so that was my conversation with Dan Grams, a really thoughtful analyst. It was a fun conversation, and we'll look forward to having him on the show again soon, which he thankfully agreed to do. You can check him out on dangramsa.com if you're not familiar with his work. Yesterday, we sat down with JC Peretz. JC is the founder of All Star Charts. He is prolific on social media. It was really fun to attempt desperately to rein him into a couple minutes of conversation, but we were able to do so. We had a really cool conversation about a lot of things. We had a deeper conversation, which we'll share with you in the coming weeks and months, about his process, how he looks at charts, how he thinks about the world from a technical perspective. But this interview in particular was his sort of outlook. We talked about stocks, talked about leadership, also got into gold, commodities, copper, interest rates, and how they're all related. He and I talked a little bit about John Murphy's work, how important it was to him thinking about intermarket analysis and the importance of not getting too focused on equities to the detriment of having an awareness of other markets, similar to what we talked about earlier in the Wrap the Week segment. So here's my conversation from yesterday with JC Peretz from All Star Charts. So JC, thanks so much for coming on the show. Really good to have you on today. Really appreciate it. And thanks for coming at us from the Traders Expo here in Las Vegas.
Sure.
First, let's talk stocks. Looking at the S&P 500, market at new highs, things like financials, so many things starting to participate. What are you seeing right now heading into year end? How are you thinking about the markets equity-wise?
Yeah, we've gone nowhere for 21 months, or we did go nowhere for 21 months.
Yes.
From the peak in 2018.
Yeah.
And now we're breaking out of that base, right?
Yeah.
And consolidations tend to resolve in the direction of the underlying trend,
Right.
which in this case, prior to the peak in early 2018, was higher. 2016 and 2017 were great years, one of the greatest runs of all time,
Yeah.
right? So a healthy consolidation is perfectly normal. We've
Right.
seen it a million times before,
Right.
and now we're resolving higher, which again is perfectly normal. What seems a little abnormal
Yeah.
is the amount of pessimism and bearish sentiment. And sentiment, as you're aware, is a very flawed measure. It's tough to, say sentiment. There's so many
Yep.
polls. There's so much crap out there.
Right.
But I think we do a pretty good job of aggregating a lot of it. And just, not to cherry pick indicators, but
Yep.
take a look at the Barron's big money polls.
Yep.
26% of
Yes.
investors are bullish.
Yeah.
This
It's
is
wild, right?
This is like more pessimism than the
Yeah.
2016 lows, 08 lows,
Yeah.
2002 lows, like way more, and we're making all-time highs.
Yeah,
So
right,
that's
right.
one really interesting.
Strange.
So,
Yep.
but JC, what is going to take stocks higher? Well,
Yep.
the fact that no one's in,
Yep.
I think,
Yep.
can take the S&P to 3,300 and the Dow to 30,000. I think that's
Got it.
I think that's where we're going.
Yeah.
If the Dow's above 27,000, to not be long is irresponsible.
Right,
Right.
right.
Same thing with S&P at 3,000.
Yeah.
So I think
Yep.
we're going a lot higher.
Okay.
An interesting. We talk a lot about intermarket analysis.
Sure.
A big reason why we've been so bullish of stocks over recent months
Okay.
is because we felt that a correction of some sort was due in gold and bonds.
Perfect.
So
Okay, sure.
it all really, really fits in. And I think
Yeah.
a big issue, not an issue, with the circumstances in the gold market
Yeah.
is that commercial hedgers have the largest net short position of all time. Right? So
right.
I'm thinking to myself, are they so short because they think prices go up?
Yep.
Probably not. And we have been so bullish of gold over the past year
Yeah.
because gold miners, gold commercial hedgers,
Yep.
you can see the CFTC data,
Yeah.
gold commercial hedgers were actually net long going into the fourth quarter last year.
Wow,
and
right.
gold hedgers actually hedge. They're never long.
Yeah.
They were net
Yeah.
long, if I'm not mistaken, check my math,
Yeah.
for the first time ever.
Yeah,
right?
yeah.
And then gold ripped, so they got it right. And now they have the largest net short position of all time.
Yeah.
I'm not getting in front of that. So for me, the gold trade is a no touch
Okay.
or short.
Right.
But I'd rather have a no touch
Yeah.
if gold's below 1,600
Okay.
and gold miners GDX is below 31.
Okay,
So,
got it.
JC, when is it time to get back into gold?
Yeah.
I think when you see gold miners with a 31 handle, GDX,
Right.
it's probably time to be
It's the
getting back
time.
into gold. And I
Okay.
don't think that's happening anytime soon.
Now, next to gold, think about copper, right? People
Yeah.
talk about Dr. Copper, how that has a lot of implications for China, just for equity market health overall. What are you seeing there?
Well, it's funny because it's actually the complete opposite of what we're seeing in gold.
Right.
Copper commercial hedgers in September had the largest net long position ever.
Right.
So
Okay.
if you're focused just on, and which is part of the short bond trade, right, or the neutral bond trade, not bullish anymore,
Yep,
because
yep.
if commercial hedgers are super short gold, super bullish copper, look at a copper gold ratio and overlay the US 10-year yield, they look exactly the same.
Right.
They are identical. So if you're
Interesting.
looking at the current positioning, or the positioning over the last 6 to 8 weeks or so,
Right.
commercial hedgers are so obnoxiously positioned for higher interest rates
Right.
that for us to be long bonds seems foolish.
That's right. Interesting. So going back to the first question, thinking about the S&P, I'm always curious, pretty bullish, pretty positive, thinking the long term. What would tell you that thesis is incorrect? Is there a signal? Is there a level? Is there a breakdown of sorts? Is it more of a sector rotation, a leadership question? Like, what would you see on the chart of the S&P or related chart that would tell you that long isn't the answer anymore?
If consumer staples make new highs relative to the S&P 500,
Okay, sure.
that's one.
Yep.
Gold makes new highs.
Yep.
Bonds make new highs. If all of
Okay.
those things start happening,
Yeah.
we're
Then
probably
it's time.
really wrong on the stock trade. We start to see deterioration in market breadth as
Yeah.
opposed to expansion in positive participation, which is what we're seeing,
Yep,
right?
yep.
If we start to see deterioration in breadth and money flow into the more defensive areas like yen, like gold, like bonds, which we're not seeing any of.
Right.
Extreme positive, bullish sentiment readings, which we're getting the opposite.
That's right.
So it's not like there's this golden indicator that
Yeah,
says buy or sell.
Yeah.
It really is, and that's where the art form comes in.
Yep.
I know I'm preaching to the choir, but
Yeah.
it really is a weight of the evidence
mosaic,
thing.
right?
And I think that if Dow's above 27,000 and you're not super long, I mean, what data are you looking at? You know?
It's a great take, JC. Thanks so much.
So that was a conversation with JC Peretz from All Star Charts. Really cool conversation. Again, the longer version that we'll share with you soon. Really, really interesting to get. I love picking the brain of someone who looks at a lot of charts like I do. It struck me talking with JC, we laughed after the interview was over, how similar our processes are in terms of how we look at charts. He focuses on trends, focuses on relative strength as a main input, and tries to follow the momentum, which is exactly the type of work that we do on the final bar. So really good conversation with JC. You can follow him on social media at All Star Charts on Twitter. So wanted to get into the 3 in 3. As you know, at the end of every show, we like to look at 3 charts in 3 minutes. I may have actually given myself a little more than 3 minutes, which would be a first in final bar history. So that's very exciting for us here. But let's get to it. So the first chart of the 3 in 3 is Dow theory. We haven't talked about this a lot. And Dow theory for me is one of those things that I don't look at all the time, but I love to kind of reflect back, especially when the market's going to new highs or going to new lows, new swing highs or lows. That's the time to glance back because it's all about confirmation, right? Charles Dow's approach was to take, basically to index stocks, look at industrials and railroads, who's producing goods and who's delivering the goods, and see if there's agreement. And at the time, the early 1900s, those were the two parts of the economy, right? The producers and the distributors. The world has changed a great deal. So a lot of people have debates on what to do, but I've been looking at the Dow Industrials and the Dow Transports since I first looked at charts, and that's why I think it's important. It's worth noting here that both of these have gone to swing highs. That's been confirmed over the last week for sure. So here's the Dow Industrials on top. The peak from July was key. Similar peak in July from transports. Transports retested that. The industrials a little bit below in September. Look at how they both now have resolved higher. They both followed through to the upside, broken to new swing highs. So by my read, that's a validation of the uptrend from traditional Dow theory, looking at the industrials and transports. The second chart in the 3 in 3 is looking at factor returns. We haven't looked at this too often. I thought of that as I was going through some of the charts earlier today after my conversation with Dan Gramson. I realized I hadn't really talked about factors a lot. We've talked about momentum, which the chart of momentum looks pretty scary. This is actually looking at all the key factor ETFs like MTUM for momentum, QUAL for quality, and so forth. And you can see the tickers in the upper left corner if you're not too familiar with them. But what this is doing is it's taking from the market bottom in August, sort of that initial pullback. This is the S&P in black, kind of that black thick line in the middle. And then these are the factors. And what's worth noting is this is the value factor, which is up 12.5% on an absolute basis from that August 5th starting point. The S&P 500 up just over 9%. At the bottom, we have momentum and minimum volatility. Those are the two. So there's a huge spread between the value at the top, momentum at the bottom, and again, that value factor, that the traditional value names emerging and showing strength is an unusual pattern. It's not the environment we've been in. We've been in more of a momentum-led environment, so I think that's a big change people need to be familiar with. The third one is looking at the TLT. We talked about this earlier in my conversation with Dan and also at JC, focus a little bit on interest rates and the bond markets. I think it's really worth noting we've seen this rotation away from bonds into stocks. That certainly has happened. And I think this week has given us a little more clarity with follow through to the downside for the TLT and follow through on the upside for stocks. So that stock to bond ratio clearly still favoring stocks overall, suggesting it's more of a risk-on environment at this point. Again, if I could summarize all my conversations with some of the experts here in Las Vegas, it has been 100% pretty confident that the market should be continuing higher into year-end. Charts at this point certainly seem to support that overall thing. So that's our show for today. The final bar. I want to thank you all so much for joining us today on Friday, November 8th, and every day. We do this show every day, 4 p.m. Eastern, 1 p.m. Pacific. You can get to us by email, thefinalbar@stockcharts.com. Please keep your questions and feedback coming. Also on Twitter @FinalBarSCTV. Give us a follow there. And have a great weekend from Las Vegas. This is Dave Keller. Have a good night.